Hi, everyone, and welcome to Chapter 9. Chapter 9 has to deal with depreciation. Believe it or not, we've done this before. We just really did journal entries for adjusting journal entries back in Chapter 3. I'm going to go over exercise 899. Again, the questions in the book. And I will take a picture of this solution. It's handwritten. The reason why it's handwritten is it's probably a little bit better than the way the solution has it. I have it worked out. In Chapter 9, they really don't do the best job explaining how they came up with the numbers. So I would advocate that you do this for the tests and even the assignments for Chapter 9. So again, just to explain this, in exercise 9.9, what it is this company bought a tractor. They bought it in the beginning of January. They paid $85,000 for it. They believe it's going to last 10 years. Useful life is how many years you think it's going to last. They assume it has no residual value. What residual value is sometimes it's called scrap value, salvage value. That's what we think we're going to sell this asset for at the end. So essentially what they're saying, by not having any residual value, at the end of 10 years, it's not going to have any value. It's going to have to be just scrapped or thrown away. And then they want us to determine the depreciation for 10 years. In Part A, they want us to do straight line method, and that's what I got down here. So I'm going to slide it up here so you can see it a little bit better and see this, again, schedule, which I taken a picture, and you have this, so you can kind of review. But again, it's handwritten, keep that in mind. So exercise 9.9, straight line. This is called a depreciation schedule. I have columns here. Year, this says depreciable cost. This says depreciation rate, depreciation expense, accumulated depreciation, and book value. So to explain what these are as I go through it, year would be just the year that you're talking about. They want us to do 2 years, so that's got a 1 here and a 2. Depreciable cost is what you paid for the asset less any residual value. Since this problem doesn't have any residual value, the depreciable cost and the costs are going to be the same because there's no residual value. So that's why I got 85,000 here. Depreciation rate is the years, in this case 10, that's the denominator, and it's what's over is 1. So it's always going to be 1 divided by the years. In this case, it was a 10-year asset, so 1 divided by 10 comes out to 0.10 or 10%. If I take 10% of 85,000, I get depreciation expense of 8,500. So how I got this number is I took 85,000 times it by 10% and got that. Accumulated depreciation is all the depreciation that you recognize over time. Depreciation expense is an expense. It's on the income statement. It's just for that year. This is all the accumulated depreciation you recognize. We did this in an earlier chapter. We also call this a contra asset account. So because this is the first year, there would not be any depreciation in that account. So these numbers would be the same always in the first year. Book value is always what did you pay for the asset, in this case 85,000. So your cost minus your accumulated depreciation, whatever's over here. If you do that math, it comes out to 76,500. So that's how I get that number. The second year is still going to be 85,000. It's not like that's going to change. This is 10% again, still the same 10% as that. 10% of 85,000 is still 8,500. So that's all the same, these first 3 columns. But now this gets a little different. Because there's 8,500 in there the year before, if you throw another 8,500 in there, you got 17,000. So how I get that number is I added what was in there the year before, plus the 8,500 I just threw in there, and I got 17,000. This column again is what did you pay for it, cost, minus whatever's over here, which is 17,000. 85,000 minus 17,000 gives you 68,000. So for part A of 9.9, the depreciation expense would be 8,500 each year. Accumulated depreciation would be 8,500, and then 17,000 in the next year, and book value. I like doing it this way. I think it's a lot clearer and more understanding. They do talk about it in the chapter. This is called a depreciation schedule. If you look at the solution that I gave you in the beginning of the semester, it really doesn't break it down this well. So that's part A. In the second part of this, all they want you to do is double declining depreciation. So, changed a couple things here. Obviously, this says exercise 9.9, double declining. This is still year. This says book value at beginning of year, depreciation rate, depreciation expense, accumulated depreciation, book value end of year. Year one, start with 85,000. Why it's 85,000 is because book value is really essentially what did you pay for less any depreciation. Well, in the beginning of the year, January 8th, when you bought this asset, you would not have depreciated at all because you just bought it and you haven't even used it. So the cost and the book value are the same in the beginning of the year, year one. What I did here, gets a little more complicated. I took 1 divided by 10, because it's still a 10-year asset, came out to 0.10. But now I doubled it. Where this 2 comes from is in the name. It says double declining, so that's where that 2 came from. 2 times 0.10 gives you 0.20, or 20%. 20% of 85,000 gives you 17,000. Again, in year one, always these numbers are going to be the same, so that's why that's 17,000. Book value at the end of the year is going to be 85,000 minus 17,000, which gives you 68,000. Because this is the end of the first year, the next day, that 68,000 is going to be carried over here, and that's why I put that there. So again, this is the end of the first year, would be the same number as the beginning of next year. 68,000 times 20%, because again, it's double declining, so that same 20% I calculated there, I'm using here. 20% of 68,000, 13,600. Cumulative depreciation is always, what did you have in this account the year before? In this case, 17 grand, so I carried that down. And then I added the 13,600 to it, and I got 30,600. 85,000 minus 30,600 gives you 54,400. Again, that's how you solve this. I would use these depreciation schedules. I would use these headings. I would look at this video, and it should be pretty straightforward. If it's asking for depreciation expense, they're talking about this column. But as for accumulated depreciation, they're talking about this, and then that's book value. Notice in this one, the depreciation expense is different, and the reason why is because the book value changes. All right, I hope that helps, and hopefully everybody's safe, and I'll talk to you soon.